All right. Hello and welcome to another episode of the Internet Capital Markets podcast. We have with us the man who's probably at the center of a lot of the Internet Capital Markets action. So, Nick, really excited to have you join us and thanks for coming on.
My pleasure. Thanks so much for having me.
All right. So to kick it off, I think I actually wanted to kick it off with your job title, right? Because your job title is Head of Institutional Growth at the Solana Foundation. And I would love for you to just tell us a little bit about what that means or, what you do in that role specifically because there's a distinction between being the head of institutional growth for a company like, let's say you're an exchange or you're a tokenization platform, you're selling a very clear product, right? Whereas in the case of foundation, there's so many different moving parts to institutional growth. And so I'm just curious if you could just tell us a bit about this role and, what it ends up looking like for you.
Yeah, that's a great question, and I think we're still doing a little discovery about it. I'm in now 2 years here at the Solana Foundation. I joined in the summer of 2023, and the mandate was really to help bring institutions to the Solana ecosystem, and for us that's financial institutions and RWA issuers. Some of those RWA issuers may be banks, asset managers, or even startups. And it's really all inclusive. Anyone who's looking to tokenize real world assets on Solana. We're here to support them in terms of, tech, ecosystem. And it's been an incredible run over the last couple of years. We've seen asset managers, including Franklin Templeton, Blackrock, Apollo, Hamilton Lane, many others have issued RWA on Solana. And then a number of banks, Societe Generale, Citi, CM Commercial Bank, have all announced exploration or tokenization on the Solana network as well. So we're still very much in the early days. Job is definitely far from done. I would say it's the top of the first inning, to use a U.S. baseball analogy. But it's not a cold start anymore. We've got some real incredible financial institutions and other asset issuers now tokenizing on Solana.
Awesome. And when you say that there's all of these different classes of products, right? Because across the examples you mentioned, there's like private credit, which is Apollo. There's like money market funds, etc. What is like if you had to think about it, to like take a step back and break it out into a framework, or let's say what is the main priorities or considerations for some of these organizations when they're evaluating doing anything with any blockchain, right? Is it more revenue? Is it more efficiency? Like, how do they think about some of this stuff?
I'd say it's all of the above, and also just good old fashioned innovation R&D, right? Just making sure that they're prepared to move their business in an on-chain direction, if that's where the market goes. I think that is now where the market is going, unquestionably. You have the Genius Act, going through the U.S. legislative process. All signs are pointing to that being signed into law. You've got Circle, recently IPO'd, one of the most incredible, IPOs in recent history. I think there's two big stories in tech right now, and those two stories are AI and stablecoins. Obviously, there's a broader crypto and blockchain movement happening, but I think the two big stories right now are LLMs and stablecoins, and RWA has a really big role in stablecoins in particular. You had asked for like a framework of what we're seeing. Obviously, stablecoins is the RWA that has had the most success on chain. There's quarter $1 trillion of stablecoins now on public blockchains, 250 billion. That's just RWA where they're not passing on the yield, essentially, right? And then you've got the next step beyond stable coins is money funds. And this is what a lot of the issuers I mentioned start with. And the reason they start with money funds, I think, is manyfold, but it's the easiest collateral for them to manage. Two, it has a NAV of $1. There's no, there's no price volatility. And then I think you see people then start to go out on the risk curve. You've got, like you mentioned, the private credit firms like Hamilton Lane and Apollo. You now have some hedge funds that have tokenized on Solana, like Brevin Howard, and Alpha Ledger is tokenizing a hedge fund on Solana right now to be announced soon. And I think that's the natural evolution of things. You start with something kind of pegged to a dollar, like the stablecoin, where the yield is being used, as margin to run the operating business. Then you've got, the money fund where the yields pass to the holder, to the investor, and the fees are what the asset manager is using, to fund the operations of that. And then you've got, out in the risk curve, like active management of underlying collateral, that has more price volatility.
Got it. If I could ask you to just sort of double click on, yeah.
There's whole other categories of RWA that I'm not really touching on, like commodities. You now see things like gold and other commodities being tokenized. You've got collectibles, and this was some of the earliest RWA tokenization, right? Like fine art, fine whiskey and wine, collectible cars, and they're essentially tokenizing to fractionalize, and also, of course, reach a broader distribution base.
I have a question here. So, are any of these tokenized assets also being utilized eventually in some tokenized form? Like, for example, if a car is being tokenized for ownership, does it also in any way reflect to the owners getting certain access to use that car based on the tokens that they own, or as of now it's more on paper and everyone's betting on the appreciation and value of the collection, whatever it may be? And I'm asking more from the perspective of, there is real estate tokenization happening through fractional ownership in India today, and rather than just betting on the capital appreciation of these homes, people are also looking at getting credit to using it as a holiday home, maybe say 10 days in a year.
Yeah. So I think what you're really talking about is like what is the utility of the token to the extent there is any beyond the speculative investment aspect of it. And I think people are experimenting with that. A simple way is just even being able to take delivery of the underlying collateral. So, for example, you've got something like Baxis, which is tokenizing whiskey on Solana. You can trade it; it can appreciate, etc. But also you can, claim the underlying bottle and have it sent to you, right, so that you can consume it. I think you're seeing that also with some of these commodities like gold, and even there's a tokenized uranium project on Solana. And so I think, from being able to take delivery of the underlying collateral to getting some kind of benefit, like for example, I know there's folks that have talked about and are tokenizing things like intellectual property, tokenizing things like sports clubs on chain, and maybe by being an investor, you get special benefits, discounted tickets or access, things of that nature.
So it also means it's enabling community building in a way.
Definitely. I think that that's where there's a really interesting design space. Obviously, there's all sorts of benefits of tokenization, as I mentioned a few, fractionalization, global distribution, 24/7 trading, easy access, from pretty much any fiat pair that has a stable coin, right? There's a lot of benefits of tokenization, but I think in addition to all of those, the design space around, using the communities that you can develop via on-chain capital markets, I think that's really underexplored and something that we'll see a lot more of.
Yeah, I think just to go back to the asset classes that you mentioned, right? If I could ask you to double click on the yield part that you spoke about, because it may not be obvious to everyone. You said like stable coins are clearly the most dominant RWA. They don't pass on the yield. Then you have money market funds. Could you just explain very quickly what the source of the yield is, why it isn't passed on, and how when you move up the risk curve, you end up getting more of the yield from your asset?
Yeah, well, so I think it's also important to remember just a little bit of kind of the history of all this stuff. So, you had stable coins coming around like the late 2010s. That's when like Tether and Circle came around, and we weren't quite in zero interest rate, kind of stage then, but we were close to it. Interest rates were declining, and the reason that stablecoins were of such interest on chain is as a trading pair, being able to, go from, say, the underlying crypto like Ethereum or Sol or whatever you were trading into at that time, to be able to know that what you were going to get on the other end was something that was going to be a dollar, or dollar denominated, allowed for, I think, a lot of both liquidity depth, and also kind of certainty around the DVP of those assets, and so also I think the issuers Circle and Tether wanted to stay very clearly out of securities laws, and at the time, under the prior kind of that now I guess is two administrations ago, but I think it wasn't clear, that yield bearing assets on chain were probably likely to be treated as a security. And so folks said, okay, we're going to do stable coins. We're not going to pass the yield along. And then they used that net interest margin to operate the business. That's how they were able to provide this kind of very valuable service for free, right? Like, yes, in some cases there's mint redeem fees, but if you were, kind of buying a stable coin on a DEX in DeFi, you weren't having to pay for that privilege, right? And that's why. Now, there are folks that are issuing yield-bearing stablecoins as the U.S. administration and others around the world have become more permissive in terms of being able to pass yield along to investors without those assets necessarily being regulated or permissioned as proper securities. So now there's more competition, and then you saw money funds, I think, come on chain in part to offer a security-based, kind of a yield offering, and you got a relatively high interest rate environment right now, right? I mean, I think interest rates are still hovering around like 4.5%, which is, quite a lot. If you're moving any material amounts of money on chain, you might as well be earning interest on it if it's risk off and you're not, trading into something else.
Got it. And so as of now, like just to be clear, like Circle and Tether are still not allowed or would take on a lot of risk if they just decided to pass on the yield as is, and it would impact their existing operations.
So Circle, in order to compete in this space, recently bought a company called Hashnote, which has the USYC token, which is a on-chain money fund. And so Circle is now kind of competing in this space with a yield-bearing offering. That is a permissioned product. But I suspect they'll be looking for ways to, whether it's through, kind of vaults or some other mechanism, allow for that yield to be passed along in a more permissionless manner.
Yeah, I think to like the topic of yield bearing versus non-yield bearing, one of the interesting things to me was, is it true that in the Genius Act there's a provision that prohibits stablecoin issuers from passing on the yield for now? And that's an interesting dynamic, right? Because I'm assuming it's for banks, like regional banks, to be able to protect their value proposition to customers. And so is a way to bypass that money market funds, or how do you see that? Do you think, are banks buying time? Like, does that mean that 2 years from now every regional bank or anyone with a customer base and a deposit base will start issuing their own stablecoin. How do you see that playing out?
Yeah, I mean, listen, JP Morgan already has issued a tokenized, like a deposit token. And they're experimenting with that. I think you'll see more of that. I think yield is tricky because for the reasons you mentioned in part, people want to protect their business, and obviously you've got banks that have checking accounts which are not really typically interest bearing, or to the extent they are, it's very, very low. And then you've got savings accounts which tend to be pass along some kind of yield, typically much less though than whatever you could get in a money fund. I think we will continue to see yield coins like USDY, which is Ondo's yield coin. I think has something in the order of magnitude of like $250 million of TVL on Solana. So clearly there's demand for that type of a product, for permissionless yield coins, and so I think you'll see those grow over time. But I understand why during the legislative process that has been excluded from the Genius Act.
Cool. I think we'll move on to what is probably the most exciting RWA for the past week or so. Tokenized stocks or tokenized stock certificates, some version of that. There's been a lot happening across both in the Solana ecosystem, but also across in the EVM ecosystem. So I think I just first throw it open to you on what your take on everything that's been happening on tokenized stocks is so far, and then I have some questions we can get into.
Yeah, so there's a few different initiatives that you may be referring to. I'm just going to list some of them, and I'm sure I'm missing some. But the recent X stocks tokenized publicly traded equities, so you can buy Tesla or Circle, representation tokens of those stocks in a permissionless manner. So you can go on your favorite DEX and swap into those. Today, I bought a little bit of Circle the other day. This is not investment advice, right? But just to try it out, and it was incredibly easy, which is what you love to see and expect, especially when using Solana. So you might also be talking about Opening Bell. That's Superstate's initiative. Superstate is initially tokenizing Sol Strategies, which is one of the Sol Treasury publicly traded companies currently on the Canadian Stock Exchange, though they recently filed to be listed on a NASDAQ, I believe. Also recently, it was announced that Republic is tokenizing what they call their mirror stocks. A lot of private pre-IPO companies, including SpaceX was the kind of the big name that I think was in the Wall Street Journal article. And then also Ondo, as I mentioned, the issuer of USDY, the permissionless yield coin, they have their Ondo Global Markets tokenized publicly traded equities coming to Solana soon as well. So those are just a few. I'm sure I'm missing many, but it's a really exciting time for tokenized equities and internet capital markets on Solana.
Yeah, and I have a bunch of questions on these. I think, the first one is, could you just help understand what exactly people are buying in different scenarios? Because, Sarthak and I were discussing this earlier in the week as well. And it's like, in some cases, you're buying, like a tracker certificate. In some cases, you're buying the actual equity issued, and you get different degrees of, in some cases, you get price exposure, some cases you get. So I'm just curious if you could just, I think there's one or two models, and you also have a beautiful PDF report, I think that you or your team has issued on issuing tokenized equities that we'll link in with the episode. But if you could just just share a bit around the different models being used here, I think that'd be useful.
So disclaimer: I'm a securities lawyer, but none of this is legal advice. And I think the key thing, and I may even abstract it a little bit, is that the key thing that you're getting when you're buying, these tokenized equities on chain, especially if you're doing it in a permissionless manner on a DEX, is what you're really getting conferred to you is not what is known as like the shareholder bundle of rights, but rather what you're getting is the price movement. So, one of the things I say is what you're really buying with these kind of on-chain representations of tokenized equities is you're buying the price, and in some cases you're getting the yield, right? We talked about a case earlier where with stablecoins, the underlying is often U.S. Treasuries and short-term credit, but you're not getting that yield, right? So you're not even being conferred the yield when you're buying a stable coin. Whereas with some of these tokens, you're definitely getting the price exposure, which generally speaking during market hours should hopefully fairly closely track the price that you could buy that stock on a brokerage, like Schwab or Fidelity. Obviously, outside of market hours, these stocks still trade. In some cases, like X stocks still trade outside of market hours, but you're going to have probably wider spreads, because there's just not as much liquidity and not as clear of a price from the market outside of those market hours. Someone like Ondo Global Markets is taking a bit of a different approach where it's a 24/5 trading, so there's not trading outside during the weekend. At least via their own interface. There may be liquidity pools that spring up to allow for folks to get exit liquidity, but again, the price discovery is a bit unclear outside of the market hours on the weekend. They use a RFQ process to kind of pull a price and kind of create the underlying shares that are backing the representation token for that equity. Then there's, of course, all of the permissioned equities. So if you're buying directly from tokenization platform like Securitize or someone where you're getting your Blackrock BIDL or your Van Eck VBIL or your Apollo Accred, you're getting actual shares in those underlying securities. Same with Franklin Templeton with their Bingy product. You're actually kind of becoming a shareholder of record and getting conferred all of the shareholder bundle of rights. So I think the reason that different folks are taking different approaches, it depends on, kind of one, kind of who they are. Like someone like a BlackRock or a Franklin Templeton, is not going to operate in a gray area. They want to be very clearly on one side of that line. Then you've got some issuers that may be outside the U.S., maybe startups may have a higher risk disposition, who have obviously some legal comfort around the way that they're tokenizing, but kind of providing something closer to what users want, which is something that looks probably more permissionless. And in doing so, though, they're not necessarily conferring the same bundle of rights that you would be getting if you were a shareholder of record in the underlying.
I think one of the things that I found fascinating was the Xtalks alliance itself, right? Because the alliance, it looked like something between, it's like a very unlikely alliance that somehow has come together, right? Because a lot of the logos on there are often competing with each other, because you have exchanges that compete with each other, then you have a DEX that competes with other exchanges, you have a liquidity provider, you have a few wallets. And so I'm just curious to hear from you on what sort of went together, what your I'm assuming you had some role in putting that together, and so what that process was like and what that means for GTM going forward in these instances.
Yeah, so I may kind of abstract the question a little bit and just talk about how I think people are increasingly realizing that we're so early in this space, and a rising tide lifts all boats, and there's, I think, a lot of crypto is very naturally like PvP, but I think there's like a lot more that can be gained from more like consortium type approaches to helping build the industry, and I think we're seeing this in a few areas. Like there's the Xtalks alliance that you mentioned with folks like Kraken and others. There's the U.S. global dollar initiative. This is the USDG initiative with Paxos and MasterCard, and also Kraken is in that, I believe as well. Then you've got the Project Open initiative, which is Superstate and Orca, Solana Foundation as well as participant in. And so I think it's really more illustrative of, hey, like we're all together pioneering a new space here. And yes, there are a number of dimensions on which many of the folks that are in these consortiums are competing with one another. But with whatever the initial volumes were, which were I think beyond all of our expectations, they're still in the tens of millions of dollars, in the first few days or week. We want to see these in the hundreds of millions, and then billions of dollars. And so I think it's a great time and a signal of the increasing maturity of the market, where instead of everyone going and just kind of doing their own thing, people are recognizing there's some strength in numbers, and folks working more collaboratively, to help build some of these primitives that hopefully will help grow the market for everyone.
Yeah, and I don't know to what extent you want to speak about this because it's about competition, but there's also another approach there's two approaches, right? One approach is the X stocks approach, where there was a tokenized stock issued as a Solana token, right, with some token extensions built in. There are DeFi apps that can provide liquidity for it. There are DeFi apps that enable trading for it, and that's why, in fact, for anybody who is living on crypto Twitter or the Solana Twitter timeline, that I keep telling Sarthak to join as well. He needs to spend more time on Twitter. But you would have seen very fast that it went beyond the logos on the announcement, right? So like you had Jupiter and you had a few others in the announcement, but very quickly other apps like dBridge and like anybody else who has a DEX was able to list these tokens, because at the end of the day they were just like any other Solana token, right? And so there's someone else doing liquidity, someone else doing tokenization, and this sort of comes together as one beautiful swap button where you can swap USDC for, which is awesome. But on the other side, you have someone like a Robinhood, which has a massive customer base, which has a KYC user base, has a direct line with the regulators, has a very strong brand, and is sort of trying to do the whole thing full stack to begin with. Right? From what I understood, they're using Arbitrum today. They're going to have a Robinhood chain that they control, that they build out. And again, I'm trying to be as objective as, like, obviously we're all Solana build, but I'm trying to be objective here. So they're going to build their own chain, and then they're going to open it up to third-party actors, right? And so there is some merit to the fact that players like Robinhood, Coinbase, Binance to some extent, they are the biggest. They have brand trust, they have a user base, they have liquidity, and they can just do the whole thing full stack themselves. So I'm just curious to know, obviously this is playing out in the market and this is real competition. And so how do you think about these two, like, approaches and uh, the impact they have on the space?
Yeah, it's a great question. One we think about a lot. I think, going back to the, Tolly and the founder's initial white paper and vision for Solana, on-chain NASDAQ, global state machine. There were obviously times along the way where, someone on the outside looking in might have said, especially with, what happened with the L2 roadmap on Ethereum, maybe this global state machine, kind of wasn't the right design. I think now is one of these times where, and by the way, with any new technology, there's these moments where you may have some self-doubt or disbelief in your vision, your strategy. I think the North Star has been very consistent for Solana. There's been no deviation from the original vision and white paper, which I think is like incredible, and just incredibly prescient, especially now. With where I was going with that was, I think the global state machine vision is looking more prescient than ever. I think markets markets want liquidity, right? Um, and I think Solana brings all that liquidity together in a single venue for any asset, all together. And I think that is what makes it so powerful. Um, People say things like, Base is Ethereum. No, Base is not Ethereum. Anyone who's ever used Base and has used Ethereum mainnet knows that these are two different things that require, quite a lot of work to kind of, trade between them. Um, and anyone who's ever used Solana and experienced that you can go from any asset to any other asset at the speed of light kind of, I think, has viscerally felt that experience and kind of recognizes the value of that technology and capability. And I think in an increasingly global world, with more and more assets coming on chain, I think the vision for Solana is going to continue to play out, closer and closer, to the on-chain Nasdaq vision that Totally had, 6 or 7 years ago.
That's a great way to frame it. I guess to close this section out, my question would be, for somebody who is looking to start up in the real world asset tokenization space, like I sort of texted you earlier, there is a gentleman who is doing that as we speak, who I was talking to. And so this question came to my mind because he was initially telling me that he wanted to build a full stack product where he does the tokenization, the listing, the marketplace, the trading. And I was giving him the example of the Xtalks Alliance and how you can bootstrap some of this by joining an ecosystem like this. And so, what would your advice be to someone who is now starting out in the real world asset tokenization space?
Okay, and I think this is kind of generic startup advice is you've got to focus, right? Like even if you're a very well-funded startup, the ones that I've seen be most successful are ones that have, kind of a very clear view of the world and, similar to I think why Solana has been successful, right? We had a very opinionated view of the world and have been building towards that very consistently in a very focused manner for a very long period of time. And I'd still say, that it's incredibly early, right? And then there's just an incredibly long way to go. And this is why I think startups that have a great deal of focus tend to win over time. You've got to have product market fit though. And so, I would say making sure that whatever your focus is that you've got some feedback from customers that indeed is something that they want. And then, I would just say plumb that well, like as far as humanly possible before, going and looking at the next thing. And so in the context of an RWA startup, for me, what that would mean is, first of all, do people want whatever it is that you're tokenizing? I think with Xstocks, the answer was clearly yes, right? We saw a flurry of activity. I think well over 10,000 wallets, buying a number of these different Xstocks. And by the way, I think there's only 50 or so Xstocks currently available. There's thousands of publicly traded equities. And so, they focused too. They said, hey, let's just start with, the names that have, a lot of retail interest, right? And I think that was really smart because now we've got, some good liquidity building in those markets, and then they can always expand later. But people all the time come and they say, I'm tokenizing XYZ. And I'm like, okay, cool, that sounds interesting, but have you validated that people want XYZ on chain, right? Like, sure, they may want it off chain. I'll give you a real good example. Very legitimate builder was introduced to me recently. Very legitimate builder in the traditional silver world, and they were saying, look how a lot of folks like Paxos and 21 and HSBC and others have tokenized gold on chain, but there's not really kind of like a lot of tokenized silver. And I'm like, okay, that's true. But do we know that there's demand for tokenized silver? And, is it more to, our earlier conversation, is it more where people may want to take delivery of it, or is it more where they just want the price action of it? What is it about the tokenized nature of silver is it that makes it more compelling, to investors than buying it, you know, through traditional channels, either in like silver ingots or bars, or in securities like a fund or ETF that tracks the commodity price of silver. And I think that's a really critical thing, is as a founder recognizing like why you're doing what you're doing, not just because there's an absence in the market for it. That doesn't mean that there's demand for it just because there's an absence. In fact, I'd often say the fact that there is an absence is the clearest sign that there is not demand. Because if there was demand for it, it probably would already be built. So making sure that you've got some real clear insight beyond just the fact that there's an absence of this thing today on chain.
Yeah, and for a founder, let's say, who has found a focus and they have some feedback on the asset they're tokenizing, if they're looking in from the outside and saying, how do I position myself to join or know when such alliances or consortiums are being created, what would your advice be to them? Like, what's the best way for them to be in good position, be prepared to join something like this?
Yeah, so generally speaking, like I think like startups shouldn't, other than for distribution, like shouldn't really partner. It's like hard enough to do a startup, like even when you control the things that are within your control. As soon as you start partnering, you now have things that are like further outside of your control. And I would probably advise like go as far as you can, with your own product, before even contemplating, joining up with anyone else. Again, other than for distribution, like I think there are real clear benefits to, being able to distribute with someone that already has access to ready buyers for whatever it is that you're looking to sell. And I think this is one of the core challenges with RWA, is that, yeah, there's, millions of Solana wallets out there, but how do you reach them? How do you market to them? How do you let them know that you have a great product? The X stocks thing was, I think, a bit unique, is because it just like really captured, as you were saying, Aditya, the kind of crypto Twitter like by storm, and like everyone kind of became aware of it very quickly, and it drove just like a ton of interest and flows. But a lot of stories look very differently, right? A lot of stories are more like they tokenize the thing, there's crickets, they've got to build up the demand over a longer period of time, and then it starts to snowball, right? And so I think as a founder, being prepared for the long slog, which you might very well face, of like, hey, getting this thing out there and then having to build it more organically, slowly over time.
Moving on from the stocks, it's like, what's the decision making process you've seen from, especially like from traditional financial institutions that don't have like a that are not already sort of positioned in the ecosystem, when they're choosing where to go, right? Where they're choosing between building a private chain or deploying a private chain. No one ever got fired for building on EVM, and then picking something like Solana. Like across the spectrum, what's your take on, or what have you seen in like how they make these decisions, or what the different considerations are?
Well, it's funny you said nobody got fired for choosing EVM. I think, we're increasingly trying to make it such that, nobody got fired for building on Solana or SVM as well. And the good news is that I think people are really starting to evaluate Solana alongside Ethereum, for these tokenization initiatives, including stablecoins. Of course, Ethereum has considerably more stablecoin TVL than Solana does, but Solana is up there with double digit billions of stablecoins, and I think increasingly Solana, the technology, is seen as a leader, and a really smart kind of ecosystem to be building in, if you're a large asset manager. I think there's a few things though, in your question. One is, am I going to build on Ethereum or Solana mainnet? And then there's another, which is like, am I going to roll my own chain? And I think that second question of am I going to roll my own chain really, I think, comes down to the kind of level of investment and sophistication that the company is willing to make. It is not an inexpensive, you know, thing to run your own chain. Like even if you're getting a large amount of incentives from, Optimism or Arbitrum or whoever, it's still a very expensive undertaking, to build and maintain your own blockchain. I'm already hearing many cases where folks, did this and, they're regretting that and looking to move, to just a public network where they don't have to maintain that infrastructure. I mean, I think you're seeing this broadly. We announced a partnership recently with R3 that we're really excited about. They were the progenitors of the Corda network, which was one of the first kind of enterprise private blockchains utilized by some of the biggest names, HSBC, SDX, HQLAX, and others. And I think we're just seeing a movement now where folks are more willing and interested to just go straight to public mainnet blockchains. They still may need to maintain, certain aspects of their ledger, like in a private network. And so the metaphor I've been using is if you were, kind of building in the cloud computing, early days of cloud computing, there were some enterprises that said, no way, no public cloud. I've got to maintain, my own servers. I got to maintain, my own private hosted environment. And then that started to loosen up and you saw like hybrid cloud where they would kind of keep sensitive proprietary data in their own, hosted environment. And then because it was cheaper to do compute in the cloud, they would move like less sensitive, bulk data into like a data lake or something like this in the cloud, and then bring back down, whatever they needed as a result of that into their own hosted environment. And then now what you see is virtually everyone is building in public cloud, right? And in fact, one of the classic reasons people used to build in their own private hosted environments was like this notion of quote security, that it was somehow like less secure to be in a public cloud than your private cloud. Now, pretty much everyone agrees that Amazon is way better able to prevent hacks, than whatever they could do if they were maintaining their own environment, right? And so I think you're gonna see a similar kind of adoption curve with blockchain, where we went from private blockchain for these financial institutions, where they only felt safe, doing private blockchain, to now where you're seeing more kind of hybrid, where they may maintain, some aspects on their own ledger, and then, kind of use a public blockchain, like, to like issue RWA or to access stablecoin liquidity, something like this. To I think we'll see virtually everyone building just on public networks in the not too distant future, because they get all the benefits without, many of the costs. So I think that's the evolution arc that we're on. And we're probably just at that beginning transition from private chains to the hybrid kind of thing, where you've got some very early innovators deploying straight to public blockchains, but I think we'll see more and more of that.
All right, awesome. I think that's a great note to end on. Unless Sarthak, do you have any other questions to close out with, or?
No, I think quite enriching for me, for someone who's not actively involved in the internet capital markets. I think I learned so much from these conversations, just being a fly on the wall, and it's been fascinating to hear this again. Thanks so much, Nick. Thanks, Aditya, for having me on all these calls and enriching me with all that you guys know. Thank you.
Well, thank you for having me.
All right, awesome, cool.